Let's talk about Schedule C income and what that means when qualifying for a mortgage, whether it's to purchase or refinance a home. Let's talk about the Schedule C income. So this means you are self-employed and you are a sole proprietor. So your Schedule C is going to be for people that like a DBA. So it's not an LLC or anything of that nature because a formal entity will have a different tax return. This is for the self-employed that do like moonlighting, odd jobs, or just a sole proprietor where it's just you Inc. doing your own thing, and it's really just a DBA that you're working under. So, sole proprietors, again, Schedule C is a schedule on your tax return. Will show up. It's on your personal tax return, and in the mortgage world, for the quote normal loans, right, air quotes there for Fannie Mae, Freddie Mac, conventional type financing for FHA, for VA, USDA, any and all those products. When somebody's self-employed and it's done via Schedule C, they're going to take a 2-year average, most likely. At least that's where the start is. That's kind of the normal piece where it's like, okay, if somebody's been doing something for a long time and we look at the last 2 years of the tax returns, they're going to look at the last 2 years. They start with kind of just comparing it and seeing if they can average it. So, for example, if for the last 2 years, the first year would have been, let's say, $150,000 net income, and then maybe the second year was 200,000. The average is about $175,000. So if that's the income they can use, they'll do it. Now, what they may also require is a P&L, a profit and loss statement, and the P&L will help validate. You can't use income from the P&L, but you can help validate that the current year or year to date, at least on that P&L, shows that they're still making the same 200 that they showed from last year, from the previous year. So it's going to take the average. Now, if you're declining, let's take the opposite. Let's say that in this case, the sole proprietor made 200 grand and the following year made 150. You don't get the average. They're going to look at the 150. And even then, that's a problem. They're going to say, man, why was that such a big drop? So they're going to ask questions. I'm not saying they're going to decline it, but I'm going to say there's going to be more questions about why the drop, what happened. And maybe it was like a new piece of equipment got purchased for 50 grand. And that's a piece of equipment that lasts for the next 15 years or whatever it is, right? That's a good explanation as to why. And then they're going to look at that P&L. And if the P&L shows that I'm back on track for the 200 or the 175 or something like that, then they can feel more comfortable. They being the underwriters can feel more comfortable about using that 150 number, but you don't get to take an average if the number went down. So keep that into perspective because they're going to use the most recent year, again, if it's declining, to figure that out. Now, with the Schedule C income, it's not just look at the bottom line and see what the net profit is. Hopefully it's a profit. Maybe it's a schedule. Maybe it is a loss, by the way, because maybe somebody has a Schedule C job on the side. They have a day job and they have a side job or a side gig and they do a bunch of write-offs. Good for them. But if that loss is there, then that's something that an underwriters or we, the mortgage industry, are going to have to consider as well to count that loss against the borrower. So it's not just that bottom line number. They do get to add back, things like home office space because again, it's part of your mortgage. I mean, it's a tax write-off and that's great, but you get add it back. You get to add back some depletion, some depreciation. You might have to subtract out like meals and entertainment, things like that. But at the end of the day, it's relatively straightforward in that sense where the calculations don't get too complicated. But again, if there's discrepancy year over year, if there's big changes, you're going to need to explain it, provide some extra potentially maybe provide some extra documentation and just help the underwriters and the lender understand what is going on so that we can get an accurate depiction of past and present and hopefully projection of future income to come so that we can make sure we're underwriting on the right income. If you have questions, as always, you can reach out to the Mortgage Mark team. We are here to help. Certainly there's some other links I'm sure around here to check out some other documentation that's going to be needed whenever you purchase or refinance a home loan. And as always, when you think mortgage, think Mark.